The envelope was certified mail, the kind you have to sign for. Daniel Marsh signed for it on a Wednesday morning, in February 2021, standing at his front door in a bathrobe, coffee in hand. He assumed it was something routine, a contractor follow-up, maybe a renewal notice. He set it on the kitchen counter and didn't open it until after breakfast. The letter was from the Internal Revenue Service. 4 pages, dense, numbered paragraphs. And on the second page, in plain black type, a figure that made him set down his coffee and read the sentence 3 more times to make sure he hadn't misread it. $320,000. That was what the IRS said he owed. In back taxes, penalties, and accumulated interest across a 14-year period dating back to 2007. Daniel Marsh was a 51-year-old civil engineer from Raleigh, North Carolina. He owned a small consulting firm, 7 employees, steady municipal contracts. Nothing glamorous. He had paid taxes every single year. He had an accountant he had trusted since 2006, a man named Gerald Pittman who operated a small practice out of a strip mall office on Glenwood Avenue and who had, for 14 years, handled everything. Quarterly estimates, annual filings, business deductions, payroll, everything. Daniel called Gerald before he called anyone else. Gerald picked up on the second ring. Daniel, read him the figure. There was a pause on the other end that lasted a little too long. Let me pull your files, Gerald said. Give me a day. Gerald never called back. To understand what happened to Daniel Marsh, you have to go back to 2007. That was the year he incorporated his consulting firm, Marsh Engineering Solutions. It was also the year he hired Gerald Pittman based on a recommendation from a colleague at a municipal conference. Gerald was personable, organized on the surface, and charged reasonable rates. Daniel handed over his financial records and never looked back. That was the arrangement. Daniel built the business. Gerald handled the numbers. For 14 years, Daniel received copies of his filed returns, paid whatever Gerald told him to pay, and assumed the machine was working. What he didn't know, what he had no reason to suspect, was that Gerald Pittman had been making a quiet, consistent error in how he categorized Daniel's business income versus personal income. Not dramatic fraud, not theft. Something almost worse in its ordinariness, a structural misclassification that compounded year after year, quietly accumulating a liability that Daniel didn't know existed. Gerald had been running certain business revenues through a personal income category that triggered different tax treatment. The deductions he was claiming against them didn't apply under that classification. The IRS hadn't caught it for years. But when an automated audit flag triggered a review of Daniel's 2018 and 2019 returns, analysts pulled the full filing history. They found the same pattern going back to 2007, 14 years of it. The $320,000 wasn't a penalty for dishonesty. It was the compounded result of 14 years of wrong paperwork, filed by a man Daniel had trusted completely. And Gerald Pittman, when faced with that, had gone silent. Daniel hired a tax attorney named Sandra Cho within a week of receiving the IRS notice. She had 15 years of experience in tax controversy law and had handled IRS disputes for small business owners across 3 states. When she reviewed Daniel's filed returns alongside the IRS assessment, she sat back in her chair and was quiet for a moment. Your accountant, she said carefully, filed these returns incorrectly in a way that is consistent and patterned every single year. Daniel asked if that was better or worse than random errors. It is complicated, she said. Consistent errors can actually help us argue he was operating under a mistaken methodology rather than negligence. But we have to prove that the taxpayer, you, acted in good faith, that you reasonably relied on a professional. Daniel had every email, every tax document, every annual summary Gerald had sent him. 14 years of paper showing a client who asked questions, responded promptly, and paid exactly what he was told to pay. Sandra said, "That is your case, right there." She filed a formal response to the IRS in April 2021, requesting abatement of penalties under the reasonable cause standard, a provision that allows tax penalties to be reduced or eliminated when a taxpayer can demonstrate they relied in good faith on a qualified professional. She attached 200 pages of supporting documentation. The IRS responded in August. Partial abatement granted. Penalties reduced, but the core tax liability, $214,000 after penalty removal, remained. The IRS wanted payment within 90 days or a negotiated installment arrangement. Daniel didn't have $214,000. His business was still running, but the uncertainty had affected contracts. 2 municipal clients had quietly paused renewals pending resolution of what they'd heard was a tax dispute. His operating account had enough to cover payroll through the end of the year, maybe not much more. Sandra filed for a collection due process hearing. More time, more waiting. Daniel stopped sleeping well sometime around October. Then Sandra found something. During a deep review of Gerald Pittman's professional background, she discovered that Gerald was a licensed CPA, but his license had lapsed in 2013. He had failed to complete the required continuing education hours and had not renewed. For 8 of the 14 years he had been filing Daniel's taxes, he had been doing so without an active CPA license. In North Carolina, practicing as a CPA without a valid license is a violation of the state's accountancy statutes. More importantly for Daniel's case, it meant that Gerald Pittman was not technically a qualified tax professional under IRS standards for the reasonable cause defense, at least not for those 8 years. This was a problem and an opportunity. Sandra pivoted. She filed a complaint with the North Carolina State Board of CPA Examiners and simultaneously amended her IRS argument, now framing the case not just as good faith reliance, but as a situation where a professional had misrepresented his credentials to a client. She requested the IRS consider the full context under a first-time abatement framework, combined with the ongoing reasonable cause argument, and attached the license lapse documentation. In January 2022, Sandra filed a civil suit against Gerald Pittman personally, professional negligence, and misrepresentation. She was seeking full recovery of any amount Daniel was required to pay the IRS as a direct result of Gerald's errors. Gerald's attorney responded quickly. They disputed the characterization of the license lapse, argued the filings had been completed competently, and suggested Daniel bore partial responsibility for not reviewing his returns more carefully. Sandra had anticipated this. She introduced exhibit after exhibit of Daniel's documented engagement with Gerald. Questions asked, documents provided, communications maintained. A client who had done everything right. The negligence case moved toward mediation in the spring of 2022. Meanwhile, the IRS matter reached its own turning point. In March 2022, the IRS Office of Appeals reviewed Daniel's full case file, including the professional license documentation and Sandra's amended argument. The appeals officer assigned to the case requested 2 additional weeks to review the history. Sandra said later that those 2 weeks were the longest of the entire process. The determination came on a Friday afternoon. Sandra called Daniel at 4:45 p.m. The IRS had agreed to a full penalty abatement and a significant reduction of the core liability based on a combination of reasonable cause, the professional misrepresentation factor, and a recalculation of the actual tax differential after correctly reclassifying the income. The revised amount owed was $47,000, not $320,000, not $214,000. $47,000 payable over a structured 36-month installment plan with no additional interest. Daniel was sitting in his truck in the parking lot of a hardware store when he got the call. He didn't say anything for a few seconds. "Is that final?" he asked. Sandra said it was. He sat there for another 10 minutes before starting the engine. The civil case against Gerald Pittman settled out of court in September 2022. The terms were confidential, but Sandra confirmed that Daniel received a settlement sufficient to cover the IRS installment payments in full, with additional compensation for legal fees and documented business losses attributable to the dispute. Gerald Pittman's CPA license, which he had quietly tried to reinstate in 2020, was formally revoked by the North Carolina State Board in November 2022 following the professional conduct investigation. Sandra's complaint had initiated. He no longer practices. Daniel Marsh renewed his 2 paused municipal contracts in early 2023. He hired a new accounting firm, a regional practice with 6 CPAs, all currently licensed, with audit review processes built into every client engagement. He meets with them quarterly now and reviews every page of every filing himself. He said something in a conversation later that stays with you. He said the worst part wasn't the $320,000 number. It was the realization that for 14 years, he had handed the most important financial documents of his professional life to someone he had never verified. Not once, he trusted the recommendation. He trusted the professionalism. He trusted the process. There are hundreds of thousands of small business owners in America right now doing the same thing, handing their returns to someone they met through a colleague, paying the bill, and assuming the machine is working. Most of the time, it is. But sometimes, somewhere in a strip mall office on a quiet street, someone's license lapsed 8 years ago and nobody checked. And the number that arrives in a certified envelope on an ordinary Wednesday morning isn't the beginning of a crime story. It is the end of 14 years of silence.